The balance sheet is the bank's financial X-ray. It gives a high-level picture of how a bank sources and deploys its funds. Investors use the balance sheet to value the shares of the bank. Lenders use it to assess the bank's creditworthiness, and regulators use it to evaluate the bank's financial health. The balance sheet of a bank looks different than the balance sheet of a typical company. To demonstrate how it's constructed, let's do a small exercise and create your own bank. You will have to decide on two things. First, how will you source your funds? Let's say you have $10 million of your own capital. This is your equity. Your customers love your bank and deposit $70 million into their bank accounts. You raise an additional $20 million from investors by issuing bonds. These two are your liabilities, since effectively you are borrowing from your customers and investors. Now you have $100 million in available funds that you can use in your bank. Let's talk about how you can use these funds to generate income. In a balance sheet, these assets represent the total funds that you can put to work. Assets will always be equal to liabilities plus equity. There are 4 different ways you can deploy your bank's assets. First is cash. While cash is the least risky option, it generates the lowest return, so it's not highly preferred. But banks are required to keep part of the customer deposits, often 10%, available in cash. This is called the reserve requirement, and its purpose is to provide a buffer in case there is a sudden withdrawal from the customers. Your bank would have to keep at least $7 million in cash to meet the reserve requirement. The remaining amount can either be issued as loans to consumers and businesses, or used to invest in financial securities, such as stocks or bonds, which sometimes appears as trading or investment activities on the balance sheet. Investments are often much smaller than loans, since they are considered riskier than loans and regulators limit the amount of risk a bank can take. Finally, a small portion of a bank's assets are other types of non-financial assets, such as property and equipment. Now, let's see how these elements are shown in an actual bank balance sheet. You can immediately spot the 3 key sections: assets, liabilities, and equity. Assets will show how the bank uses the funds. For example, you can find different types of loans issued under assets. Liabilities and equity are the other side of the equation, which shows how the bank sources the funds. Customer deposits, for example, will show up under liabilities. Let's check if this bank is meeting its reserve requirement of 10%. They hold $22 billion in cash. The customer deposits are $165 billion. They hold 13% of their deposits in cash, which is above the required level.